How do you want to?
Yeah, I think we should have folks joining now.
All right.
So folks are going to be muted automatically, and then when we start Q&A, we can unmute everyone.
We'll let a few more people come in, Jay. I think we're at like 13 and 14. So. Hope everybody's doing great. Thank you guys for joining. We're just going to give the participants a few more minutes to log in here. All right, see some more people joining. For those of you that are just joining us, you will be muted during this session, and as we get to Q&A, Jay will unmute you so we can answer any questions if time permits throughout the end of this webinar. We're going to do our best to stay on time. We do appreciate everybody. We know it's 8:30 on the East Coast time, so a few more coming in here, Jay.
About 19. I know we have close to 40 who have registered.
We'll give it a few more minutes. Guys, thanks for your patience as people get logged in here. Thank you all for joining. We're just going to give a few more minutes for people to join in, so give us just a second. Like we got a few more coming in here, guys. All right, Jay, looks like we're a little over half.
Okay, yeah, I think we can get rolling.
Sure. Well, welcome everybody. We appreciate your time this evening. Thanks for joining us. We're really excited about this new investment opportunity we have to share with you. My name is Andy Crawford. I'm the head of investor relations for Prosper Capital. Paired with me is Jay Belcar. I also am a key principal on this project with Jay and the managing principal of Prosper, DJ Hume, on the call. Jay, go ahead and introduce yourself.
Yeah, thank you all for joining. Appreciate you all taking the call to join us this evening. My name is Jay. I think some of you on the call know me, some of you, those who don't. I'm based in Cincinnati as well, have known Andy and DJ for over 4 years now, and have had several lunches and dinners together. We've partnered on some of the deals prior, and it's been a phenomenal working relationship. So on this deal as well, we are partnering up, and we are basically sharing responsibilities in terms of property management, construction management, investor relations. So I'll be overseeing some of the construction management aspect of it, and also will be boots on the ground here in Cincinnati. So all three of us are local to Cincinnati, which is where this deal is. And I believe DJ is on the call as well. So DJ, if you want to just unmute yourself for a minute and just introduce yourself, that'll be awesome.
Yeah, DJ Hume here. Appreciate everyone joining. I'm the principal here at Prosper Capital, and I help manage the day-to-day operations for our management arm and work directly with the team. So, been working really closely with Jay and also Andy, and I've been working together for 4 or 5 years now. So, I'm looking forward to presenting this opportunity to you all today.
Awesome. Thanks, DJ. All right.
Well, Jay, without further ado, why don't we get into kind of the story behind this property, the investment that we're excited to share with the group here. I'll start with kind of like the backstory on why this opportunity even exists. It really came from one of our broker relationships. Why we see value in this opportunity. The seller is fairly motivated, an out-of-state seller from California who's been managing this property fairly poorly. A lot of repeat turnover from property management, right? Third-party management. That's where we implement our value add strategy, having in-house property management with Prosper Communities. It's a management intensive property. Obviously, the previous seller was trying to execute a business plan a little bit similar to ours, transitioning. About 80% of these residents currently are CMHA residents, which is the Metropolitan Housing Authority residents. Can be management intensive, but we see a lot of value and upside. Roughly around, I think we said, Jay, right around 34% in upside for rents on this property, which is phenomenal value for us. We are seeking around 1.6 million in equity commitments from investors. That represents about 70% of the equity position. So each 1% equity share equals is roughly around $22,857, rough math in equivalent there. And we're really going to approach this opportunity in two phases. Phase one, which is the primary phase, is transitioning these CMHA residents to market rent units. We're going to do that by implementing and leveraging Prosper Communities' in-house construction management teams and really approach it in like a batch unit renovation sort of scenario and leverage efficiency there, where we might do 4, 6, 8 unit renovations at a time to really achieve, ultimately executing our business plan, which is getting all those 80% of the residents over to market rate rents. Phase two, roll into that. That is more of the market rent units right now that are non-CMHA and just transitioning them over and renovating those units. So, Jay, anything to add?
No, I think that was a good summary, Andy. I think the only thing I would add is some folks might have a question, why this specific property? Why Batavia? I would say that all three of us share the same philosophy. We have underwritten over 50 deals in the last 7 months. We all know last 7 months was an extremely slow time in the market. So why this one? So when we look at a property to buy, we are looking at the property itself, the neighborhood, and then the operational upside, right? And we want to make sure that holy trifecta is being met. It's not just about the property. It's just not about the location or the operational upside. In this case, we are getting all three. What I mean by that is the property is relatively newer. It's a 1980s property. So some of the things like cast iron plumbing and, the stuff that's heavy maintenance, we don't have to worry about it. It's still pretty updated. The other thing is location. Batavia, for those of you who are in Cincinnati or are familiar with this market, already know that this is a Class A suburb of Cincinnati. So that we know that when we put all of this work in, it's going to be worth something, because if you're putting your money and CapEx dollars in a neighborhood that's not really going anywhere, the juice is not worth the squeeze. So property, neighborhood, and third, Andy just talked about 34% gap between market rents and where the rents are with this property. So that's operational efficiency improvement. So we've got an upside on all those three things, and that's what makes it a really good deal to go after.
And I'll just touch, great explanation, Jay. And I'll just touch on when we did property inspections a few weeks ago and we're on site. I got to say, I was pleasantly surprised. A lot of Class C properties that serve CMHA, you would assume that they're not of the greatest shape, but common areas were very clean. The washer dryer areas for common laundry were clean. The exteriors were clean. So I think we're really starting off with a great property that is it's not in shambles by any means, even being a Class C property.
Absolutely. Yep.
Highlighted on a few of these already, but we just kind of reiterate. I think the biggest takeaway from this slide for all those joining is really the location aspect. We touched on already, where we're at 34% or so below market rent, but maybe understanding for those that aren't familiar with Cincinnati, who are the major employers in this area. And the one that excites me the most is TQL, which is the largest privately held and fastest growing company in Cincinnati. They're a huge organization, multi-billion dollars. They employ a lot of people in Cincinnati, and they're less than 3 miles from the subject asset here that we're talking about. Obviously, staple retailers like Walmart, Meijer, Home Depot. We have the Eastgate Mall that was previously bought for redevelopment. I think they're in a phase 2 design for that, which will be mixed use commercial property and possibly even some residential. And also we have other employers like Cincinnati Millicron. We'll kind of go into the area a little bit further, in some healthcare system employers, UC, and another healthcare employer out there. So it's a strong area. You want to talk about a little bit, Jay, on your aspects through the investment highlights?
Yeah, I think you already talked about the neighborhood, but one of the other things I want to highlight is Batavia used to be a rural area of Cincinnati back in the day. Because one of the questions you guys may have is, why is this property here with Section 8 or CMHA tenants if it's such an awesome neighborhood, right? Batavia used to be a rural area about 20 to 30 years ago. Now it's very urban. It's actually a booming suburb of Cincinnati. And that's why this property is no longer required to be a CMHA or Section 8 property. Also, the tenant base, when we walked the property, was completely different. So there is a little bit of a stigma about Section 8 that we don't know how the tenants are going to be. But actually, all of the units were very clean, very well maintained. And the added benefit is that rent gap that we are talking about. There is a huge rent gap between existing rents and also the approved CMHA rents. So CMHA provides the maximum of 1198 for 2-bedroom, which is actually higher than our pro forma. So our first goal would be to maximize our CMHA rents. And that way we get really good return on our dollar spent, because we won't even have to truly spend the money on the interior of the units and still get that rent upside, thus giving a really good ROI on our renovations. So there are a lot of different aspects of this deal that we will dive a little bit deeper into that makes this investment really, really good. And I think also the unit layouts, the unit mix is extremely favorable. It's predominantly 2-bedroom units. Now, why is that important? Because usually 2-bedroom units attract families, and families end up staying longer. So you have less turnover costs. There's very few 1-bedrooms, but mostly 2-bedrooms, large units for this area. And that's, again, another thing that's attractive about this property. Okay.
A little bit about the investment summary. Purchase price is $4.5 million. As Jay said, total of 54 units, a great mix of 2-bed, 1-bathroom, and 1-bed, 1-bathroom. Vintage is 1980. It is a C-class that we're looking to transition, obviously, with our renovation project. Looking to hold this property 7 years. Our IRR, 16 to 17% is our target. The average annual return, 19 to 20%. Cash on cash is strong at 8 to 10% on our average over the 7-year hold. And the equity multiple at, I think we ran slightly conservative at about 2.37. So it falls right in between our target there. We will be paying a pref after year 1 of 5%. That is annualized. So on a $100,000 minimum investment, $5,000 or $1,250 per quarter paid out to our investor partners. And one thing to note, those that are familiar with syndications that have been looking at a lot of decks, 16% IRR used to be the target everybody's aiming for. It's kind of hard to achieve a 60% IRR in today's marketplace, and you're not really seeing many. So I think the fact that we've kind of hit that target for this asset is a really good indicator. That's a great property for us. Jay, you want to talk a little bit about the financial overview?
Yeah, absolutely, Andy. So the purchase price on this property is 4.5 million. We will talk about a seller credit that we are getting, about 37,500. Capital improvements, which is essentially your interior and exterior renovations, are valued at around 1.1 million. That also includes 10% in buffer. So actual projections are a little bit lower. Operating reserves, that would include essentially our reserves for paying taxes, insurance for the first 6 months of the operations of the property. That's at about 225K. 2% would be acquisition fee. Acquisition fee will be calculated basically on our purchase price. And those of you, again, familiar with syndications would probably agree that 2% is a very, reasonable number. Usually acquisition fee and asset management fee ranges in the 2 to 5% range. But our whole philosophy has been not to overcharge on fees, but really over deliver on the results at the tail end. And when the property performs, that's when we as sponsors actually get compensated. Asset management fee is going to be 2% on the income earned, the monthly income. 1% sale and refinance fee, and that is associated with the amount of effort that's going to be involved to find a lender for refinance, get all the documentation together, and then also the same process with exit, finding the right buyer for the property, renegotiating and negotiating the pricing, and then finally exiting to hit our target returns. Estimated closing costs on this is going to be about 88,000. So our total all-in project costs, we are looking at about 5.96, let's say about 6 million. Out of those, loan amounts are 4.48%, and investor equity is 1.486. Now, of course, investor equity, that number is going to change based on the appraised value of the property. So the appraisal is currently in progress, but those are just estimated numbers. Loan to cost, what that means is, again, lender, how much are they lending on this property? So they are willing to lend up to 85%. And that's, again, a key number to note because most lenders would not lend more than 75% unless they actually see a potential in a property. So the lender is actually willing to lend 85% on this property, up to 85%, which is a really good thing. So we have better leverage that helps us with achieving those target returns. Our exit cap rate is at 6.8%. Properties are actually selling right now in this area for high fives, low six cap. So 6.8 is a projection based on CoStar projections. CoStar is a very trusted source of data in commercial real estate world. For those of you who don't know about CoStar, it is the best source for data. So we are actually projecting a 6.8 exit cap. What that means is that we are assuming that the market's going to be a lot worse when we try to sell the asset. So that way we are being conservative in our exit projections as well. And then projected value at sale is 8.4 million, which is going to be around 155K per door exit price. But actually properties today are selling in that area for 157 to 159 per door, stabilized properties that have been renovated. So achieving that number in 7 years, in my opinion, I think we all think that it's going to be extremely conservative, right? So
Great points.
Anything else to add, Andy?
No, I think you hit on all of it. I think one thing to note for those that aren't as familiar as others in this space of investing in real estate syndications is an 85% loan to cost is a strong number. You don't see it very often. So it's great that the lenders are behind this project. It makes me feel more comfortable about this project. And I think the investors should be as well. That was my only other comment.
Awesome. And I think for the folks who are not familiar with syndications, just a couple terms I would like to explain is average annual return. So that is your average return throughout the course of the deal, which is going to be a combination of returns that you get from the cash flow, which is the rental income collected, but also the profits from exit. So that is all of your returns combined. If we split that over the course of 7 years, you're going to get about 19 to 20% return. So that's the average annual return metric. And the other one we had was pref return, which is preferred return. Essentially what that means is you as investors would get 5% before we as sponsors get anything. After the pref return has been met and you have received your 5%, after that, it's going to be a 70-30 split. So payouts to investors are going to be prioritized, and that's the definition of preferred return. So just wanted to kind of clarify that for those of you who were not familiar with the term. Oh, all right. So these are some of the exterior pictures of the property as it stands today. As you can see, it looks a little bit dated, but we don't see major signs of distress. So it's not like the windows are boarded up or there's a lot of signs of disrepair and damage. So overall, the asset as it stands today, it's in good condition. But our goal would be to bring this asset to the 21st century by doing some work on the exteriors, repairing the roofs, doing exterior painting, new signage. The signage looks very 80s, rebranding the whole property. And we have some example pictures of some of our previous properties on how exactly we do that. So this is what an example exterior rebranded property looks like. So this is a true property that we bought about 2 years ago, brick building, very 80s. And then we rebranded it, new signage, completely changed the tenant base. It completely looks different from the outside. So that is our goal with this property as well, to take it from more of a B minus property and take it to a B plus level, right? So that way now the reputation of that property in the neighborhood changes and it starts to attract even better quality tenants. In terms of, yeah, go ahead.
Real quick, Jay, because there's a question already in the queue, but I think it's a good time to segue into the rebranding, right? An existing property that has bad reviews on you, right, that you buy, it shouldn't scare you away from ever buying a property, because part of the process of rebranding is, encouraging newer tenants to build up Google reviews for the new branded property. So I hope that answered that question of, if an existing property has bad reviews, what is the business plan in order to change that? And that's all encompassing. Part of what Prosper Communities does very well is it achieves 5-star Google reviews from its tenant base. So not to interrupt, but I think that was a good segue into it.
Yeah, I think that's a good answer, Andy. And actually, if you look at Prosper Communities and Google reviews, you'll see all the 5-star reviews. And if you have any experience investing in apartments and looking at property management companies, almost nobody has 5-star reviews. They're all like 1.8, 2.1, because usually the tenants are going to go leave reviews when they're really pissed off at you. When they're happy, they're usually not going on Google leaving reviews. So it really takes a lot of effort to earn that kind of positive feedback as a property management company. So, and if the property currently has those issues and bad reviews, that's truly where the opportunities is. That's where we can actually go in and bring in operational efficiencies and actually provide a better service to our client base, which is our tenants, and earn those better reviews, right? So here's an example, true example of a property that this team has done. This is what the after looks like. So similar asset, pretty much identical layouts on this asset. And this is what that asset looks like right now. So this is all not only achievable, but it's something that we have tried and tested before. And we know it works. And in many instances, we have actually gotten higher than pro forma rents after these renovations have been done.
And I'll just add, Jay, too, that property, that subject property is a property that, I own with Prosper and its investors. And it's not that far from Batavia Meadows. So we've rebranded and renovated the vast majority of units in this property. And, I hate to say it, but a lot of times when you look at these pictures, the thing that gives you operational efficiencies when you're doing unit turns and unit renovations is it's quite boring, right? We use the same Cali-Pro 20 mil LVP, use the same agreeable gray paint, use the same, shaker cabinets, same fixtures, same toilets. But that leverage in, buying products at a better price by consistency, and it's systematized. So those that have never invested with us before just know that last year we did 50 unit turns just over the portfolio. So having a 54 unit property and achieving unit turns like this isn't something new for us as a group.
So, all right, rent survey. So I think we can potentially wrap this up fairly fast. We don't want to go into every single number on this slide, but what essentially this slide is talking about is what are the in-place rents versus average market rents. So if we look at the subject property, we are getting about 95 cents a square foot, and we are projecting about 1.27. So that is basically in comparison with our comps. What comps mean is we look at the properties in that area which are comparable. So we are not comparing this property with a brand new development that has a swimming pool, gym, and all the amenities. We are trying to do an apples to apples comparison of with assets of similar age, and we are trying to see what are those properties renting at, and based on that, what we think we can rent our property at after it is stabilized, after all the renovations are done. So looking at some of the rent comps, if we look at 1 bedroom and 2 bedroom properties in the area, if we look at some of these comps, they are of similar age, 89, 74, 79 construction. And if you see the rent per square foot that they are achieving is anywhere between 1.26 to even 1.57. So if the point to note here is that our pro forma rents at 1.27 are still at the bottom of where our comps are at. So if we are able to overperform and actually get what our neighbors are getting at 1.5 plus, then our numbers are going to look even better. But just to be conservative, we are trying to see, okay, even if we fall at the bottom of what our comps are at, we can still hit our metrics. So average of the comps collectively is 1.44 per square foot on 1 bedrooms and 1.35 on 2 bedrooms, but we are projecting 1.27 for our underwriting purposes. Andy, anything else you would like to add?
No, I just think you made a great point with two of the things that stand out to me on this slide, and those that aren't experienced investors, just to know, is vintage and distance from the subject property. And it being right there, a lot of syndications you'll look at, offering memorandums, and they'll have comps for properties that aren't even comparable properties. So the fact that this is, super conservative, almost at the bottom of subject comp rents, to me shows just a really strong opportunity for us. So, Great slide. I'll talk a little bit about this, Jay. We tend to try to keep this size pretty simple. There's a lot going on here. This is our sample cash flow and return on investment sensitivity, really the nuts and bolts for an investor to say, hey, if I'm trusting you with my capital, what am I getting back for that trust, right? How are you going to perform for my investment? And I like to keep it very simple and saying for the minimum investment of $100,000 through the life of the deal, right? So we're talking preferred returns. We're talking about your equity growth share, your recapitalization. At the end of this deal, if we hit our expected conservative, which is the 2.37-ish equity multiple, you'd expect to get $236,000 $686 back. What I love about this slide is it shows you the very conservative, expected conservative, aggressive, and ambitious. And Jay, I know we've talked about this before. This slide can lose a lot of people that aren't experienced investors, but just know that there's a lot of variables that can impact the property at sale, right? The exit cap rate, the average rent per unit, and that's all kind of laid down in these assumption inputs here, which is really clearly laid out. So for the investors, that is where we are with a $100,000 minimum investment. Is your return would be projected $236,686 with recapitalization happening at refi year 3, but projected right around 46%. So around $46,000 of that 100,000 would be recapitalized to you on year 3. The remainder at disposition. So, Jay, anything to add?
No, I think that was a good summary. I think these slides have already been shared, but we will be sharing the recording and the slides again. So you all can review this slide in detail. If there are any questions, we can always do a follow-up call as well, because I know, there's a lot of numbers on this slide. One thing also to note is year 1, you will see 0% cash on cash. Because this is a value add deal, the money that the property makes in year 1 goes right back into property to fix it up. So you cannot expect any cash flow distributions year 1. Year 2, we start distributions, but they are still very low. So our target is to start distributions month 18. Year 3 onwards is when cash on cash starts to go up, or cash flow distributions start to go up. And that's because once the property is stabilized, that's when it starts to cash flow really well. And that's when the distributions start to happen. So there's a key difference here. This is a value add deal, which is why the returns are really good, but you don't get that day 1 cash flow that you would typically get with a Class A brand new turnkey property. But then on the flip side, on a turnkey property, there is nothing you can control in terms of how much value you can add. You're completely relying on the market growth for the value of the property to go up. Here, at least we can put in all this work and increase the value of the property, and therefore we get a better IRR as the end result. So I think with that, we can keep moving forward. I know we are getting some questions, so we'll answer those questions towards the end of the presentation as well. I think they're all good questions. Debt terms. This is basically the financing terms we've received from the bank, from the lender. This is going to be a bridge debt, and this is from a local bank. So for projects like these, where there's a pretty large renovation component involved, agency is sometimes not the best choice, because agency is not going to give you any dollars towards construction and renovation, which is why we chose to go with a local bank. Additionally, they're also giving us really good leverage, up to 85% LTC, and conservatively about 80% LTC. What that means is they're going to give us 80% of the purchase price plus 80% of the construction price. So that's a really good leverage and really good loan product to have. Interest rate is going to be fixed at 7.5% for 36 months. The term is 300 months. 24 months is the interest only period. So for first 2 years, we will only be paying interest. Typically, we see that to be 12 to 18 months. So 24 months IO is really good, because that gives us more time to stabilize the property and not have to pay for that principal payment. So it helps us conserve cash. Are we going to need all 24 months? Maybe not, but it's always good to have more than you actually need. Amortization is basically for how many years the loan is going to amortize over. So that's going to be 25 years. The prepayment penalty, meaning if we repaid the loan sooner than when it's due, which is at the end of 3 years, the prepayment penalty is going to be 3-1, meaning 3% prepay penalty year 1, 2% year 2, and 1% at the end of by year 3. So I know that in our projections, we have a refi. Refi is projected at the end of year 3. Our goal would be to actually do it in the beginning of year 3, and in our underwriting, we have already projected a 1% refi penalty. So that's already factored in our underwriting. But this prepay penalty is not extremely severe. Most agency lenders are going to be at 5, 4, 3, 2, 1 prepay penalty. Additionally, the prepay penalty will be waived if we refi with the same lender. So overall, really solid debt terms for the type of deal that we are dealing with. Now, on the refinance side, meaning after the property is stabilized, what type of debt are we targeting? So we will be targeting agency debt, Freddie or Fannie, because that's a long-term stabilized debt. Interest rate, we are projecting about 6%. Right now, agency is hovering in the low 6s. In about 3 years, we are projecting we will get about 6%. If the interest rates drop further down, that might actually look even better for us. Term would be about 5 to 7 years fixed. Interest only period on agency debt is typically 0, but sometimes you do get 12 months. This would be amortized over 30 years, which is very standard for agency debt. Prepayment penalty will be, it's unknown right now. It will depend on what type of product we choose. It could be a 54321, or it could be 3322111. It all depends on what product we will choose at the time of refinance. LTV, or loan to value, typically 75%, and that's at actually 1.35x DSCR. So for refi, we need at least 1.25x DSCR. So we feel very comfortable that we can refi at 75 LTV with agency. Refinance cap rate is actually 7, which is again even higher than our projected exit cap rate. So very conservative refi cap rate, and appraised value of 7.1 million. So overall, these terms for refi as well, we think are very achievable. Also, not just we think they are achievable, but even talking to a few mortgage brokers that we know in the area, we feel that these are achievable refi terms that we can get after stabilization of the property. Andy, anything else on debt terms?
No, well said.
Okay. CapEx and reserves. Okay, so I think I can give you guys a very quick summary of CapEx. CapEx is basically renovations, and some of you who have already invested in multifamily deals or really any commercial real estate deals would be very familiar with value add strategy in commercial real estate. You can add value by improving operations, which is one side of our business plan. The other side is actually improving the property itself, right? So deferred maintenance, we have 7,500 set aside. Some may argue that's a very small number. Well, that is a small number because basically we are redoing a lot of the things already. So a lot of the other deferred maintenance is going to be addressed by all of these other items that we have on the list. Partial rehab on unit interiors, we have 39 units at $10,000 per unit marked for that. The reason for those partial renovations is after we walked all the 54 units, there were only about 6 units that were not in the best shape. All the others were very much livable, although slightly dated. There were no major signs of disrepair. The electrical panels are already updated. So besides new flooring, new paint, light fixtures, closet and door knobs and hardware and new kitchens, there is nothing else that needs to be done behind the walls. And for that, we think 10 to 11K per door is more than sufficient. Now, there were few units that needed a little bit more work, and that's about 10 units that we are targeting at 150K, which is 15,000 per door in renovation costs. At the same time, we are going to experiment with the levels of upgrades. So we may do a few units as premium upgrades with stone countertops and tiled showers. We might do a few units with laminate countertops and 3-piece shower surrounds, which are a lot cheaper to buy and install, and see what kind of response we are getting from the market. And based on that, tailor our business plan accordingly. But we have enough set aside for CapEx to be able to pivot either way. Water heaters, none of them have to be replaced immediately, but we are keeping $15,000 in reserves. So as they go out, we can replace them. They're all, none of the water heaters are individual to the unit. There are 2 water heaters per building. HVAC, they're going to be individual per unit. and some of them honestly are old. All of them, when we inspected the property, were working. But we have 30K, which is about 6 HVAC systems that we can replace. So we have a reserve set aside. So while we are renovating the property in the first 2 years, if we have any HVAC systems fail, we have about 30K set aside for that. So all in all, that totals out to 592, 500, and that's set aside for our interior renovations. On the exterior, we have some pieces of our vinyl siding that we have to repair. They have some holes in them. That is 7,500 is actually an actual quote. That's not a projection. So we have already started to get a lot of these quotes, and we know that they are arriving at or below what we had projected. Gutter replacement and gutter guards. Again, that's an exact number. That's because that's the number that we have a quote for. So it's not any type of guesswork, but actual figures that we have gotten from contractors. Roof replacement, 3 big buildings, 99,000, and then 1 smaller building at 8,000, which is across about 4 bids that we have received so far, and we plan to get more to get the most competitive pricing to do this work. Landscaping, set aside about 14,000 just to clean up the overall landscaping. Tree trimming at 5,000. Window and sliding doors, we will be replacing all of them. They're all dated, single pane aluminum. Pressure washing and painting all of the exterior. So currently the buildings have a beige and brown color scheme, just making them a little bit more brighter and converting them to white and black or gray and neutral modern tonality. That would be our goal. New signage and new branding with new light fixtures and everything. So we've got about 10 grand set aside for that. Parking lot seal and stripe, we have 16,000 set aside, and that's the actual bid as well. We have about 7K set aside for a dog park. We had a swimming pool at the property that has now been closed off and it has been filled in. So we are planning to make or create a dog park in that area, but that's kind of on the back burner for now. That's not an immediate task. And then again, deferred maintenance of about 20K on the exteriors. So about $410,000 on exteriors. And then on the bottom left side, you see that we have our reserves. So that's 5 months of principal, interest, taxes, and insurance. That's what PT stands for. So about 5 months of that in reserves. Year 1 capital injection. So if we have to inject a little more capital in year 1, we have about 50K set aside for that. So total operating reserves of 226K, but we are getting about 37.5 back in repair credits from the seller. So 188,500 would be our operating reserves that would be raised. So that's kind of the breakdown of our total capex and reserves in finer detail. Again, we'll be sharing the slides so you can review this as well. Anything else, Sandy?
No, you hit it right on the head.
Right.
Very well done. Let's
Alrighty.
move into the location overview. I talk a bit about Batavia. We've already kind of suggested our thoughts on how we like this market. 20 minutes from downtown Cincinnati. We've got this great map of just the zones
Yep.
prior there. We can move on, but the next page being the employers, right? And those that know Cincinnati know these employers. Those that aren't from around here, the great part about Cincinnati, I think in 2023 we were number 3 in rent growth at about 3.3%. So strong rental market. We still have a unit shortage. I think there's still a lot of opportunity. We love this market. That's why we invest in Cincinnati and invest in the backyard. If you want to go to the next slide, Jay.
Mhm.
Just a little bit about the location overview. I mentioned before its proximity to TQL, which is one of the fastest privately held companies in Cincinnati, fastest growing. Many staple retailers here. A lot of these names are probably familiar with you all. Employers like Millicron, UC Clermont, Mercy Health, Nestle, Farina has a huge plant not too far away from the property. A lot of new industrial builds out there too. So you're seeing a lot of industry continue to move to Batavia. Is a strong submarket, for employment. So all of those employment factors really help bolster that local economy there, and really provide, which the next slide you can head to, a strong median household income at roughly 75,000. So what this means to us and to you as potential investors is it's a solid base for potential new residents, right? And as we continue to push to market rent and there above, having those that can actually afford it, that live within that several mile radius of the said property or Batavia Meadows, gives us a lot more stability, right, as we continue to execute our business plan. Anything to add, Jay, or you want to move on?
No, I think that was a really good summary of the location. I think, and of course, you all are free to do your own research and due diligence. What you will see is there's a lot of new construction in Batavia and a lot of the single family homes being built, which are starter homes, 3 to 4 bedroom homes. They are being sold for anywhere between 400 to 500K. And I think for Midwest, those are pretty significant prices. So that clearly tells you that this is not so much of an area where you'll see a lot of workforce housing, but young professionals, working families are moving to this area, which is why the school ratings have been constantly going up in this area. And also that's why we are seeing a lot of development. So it's all tying in together, as Andy mentioned, employers moving to the area, families moving to the area, a lot of new development to support all of the movement of population to this area. So it's a really good submarket. And in general, east side of Cincinnati has been always a very stable market, a much more predictable market, which is why we like the neighborhood and the value add potential of the asset itself. So
I'll just mention too, Jay, you know, I live on the east side of Cincinnati. This property is less than 10 miles from my personal residence. We own as a group several assets on the east side of Cincinnati. We're very happy with them. I've owned some for upwards 4 years plus. I have a personal portfolio on the east side of Cincinnati, so I'm very familiar with this part of town. And you know, you got to ask yourself, if you're not business savvy and you don't have a lot of experience in real estate investing, if you know that the largest employer in Cincinnati, the fastest growing employer, privately held company, TQL, is in their home base, their headquarters is in this area, that means something to me, right? So I think that we'll see continued development, you know, continued industry growth, residential development in this area. So
I think we can now move on to just about our team and track record.
sure. I'll just highlight a few things on this, Jay, and feel free to add. You know, as a group, you know, Prosper Capital and Compounding Capital, you know, Prosper has over 7 years of combined property management experience, more than 500 residential units and transactions, 40 million, you know, in total dollar transactions, which is a nice track record. 5 properties full cycle from purchase to sale. And one point that I really want to emphasize for those on the call that are new to investing is my favorite point here out of all these number signs is fully vertically integrated. And what's important to know about what that means with the sponsor, regardless of your interest of investing with us or other sponsors, you got to ensure that interests are aligned with who you're giving their capital to, right? A fully integrated model, which we are, has in-house property management, which is Prosper Communities, and in-house construction management, which is within Prosper Communities as well, and asset management, which is shared between Compounding Capital and Prosper Capital. Why those are important for you to know and to understand is there's a lot of leverage of efficiencies when you're not using third-party management. One, there's more skin in the game. The sponsor has a vested interest in the asset that they own, right? So they're more willing to do things like watch overhead, make wise choices for renovations and watch costs. And lastly, you know, tenant satisfaction and really taking an interest in improving the communities in which we buy assets, right? That's the name of the game. Jay said it before. Our customers are our residents. And when they're happy, we're happy, and the asset does well, right? It's all part of the bigger picture, which is to really grow one thing, and that's a net operating income for each one of these assets. What that means to you as an investor, that means growth of your equity share and success of the business plan implemented by the asset manager. So just a key takeaway. If you take away one thing from this this webinar is understand whoever you partner with as a sponsor, vet them, make sure you know who you're partnering with and if they are vertically. Jay, you want to talk a little bit about the average results over the portfolio?
Sorry, say that again, Andy.
Want
Average
to
results?
highlight on the average results we
Absolutely.
have from your experience.
Yes. So these are essentially our combined average results. ROI since inception on all our properties, average annualized return has been over 20%. So some of these projections that we are putting on the slides, at least we are achieving those. So it's not just marketing stuff. It is something that we are actually achieving on our current deals. We recently exited on one of our deals. We have about collectively 5 deals that we have taken full cycle. And between both of our teams, we have done over 25 deals collectively, spanning actually it's over 1,000 units if we put both of our resources together. So this is not our first rodeo. We have done this many times. We have executed on deep value add renovations many times. We have stabilized properties which were completely vacant and filled with squatters and homeless people. So this is actually a lot nicer of a property. So we have experience doing this. And the reason we are all working together on this is for that one bullet point, fully vertically integrated. But the most important point I would like to highlight is alignment of values, ethics, and work ethic. So we have realized by working with each other that our values, our personal values are aligned and our work ethic is aligned. We are always working and nobody needs any reminders. And that's very important when you are collectively executing on these responsibilities and we are collectively responsible for the capital that you are investing in the deal. And then second, we are bringing in complementary skill sets when we combine our resources. So the construction management experience that both of our teams have, the property management experience and systems and processes that Prosper Communities has developed over the years, and now the deal finding and broker relationships with lenders, all of that is coming together for that full vertical integration in this deal. That way we are not relying on a third-party company for any of this. This is all going to be done in-house by our teams. And why is that important? Because that way we have greater control over the execution of the business plan. That way, if something goes wrong, we cannot point fingers at somebody. Oh, guys, the property is not performing because our property manager is not doing a good job. We've got no excuses because everything is in-house. That gives us better control and also higher chances of success. So these results are real results, 20% ROI since inception, IRR of 19% on all the deals that we have sold. And our philosophy always has been to underwrite as conservatively as possible. And if the numbers still work, and also on top of that, if the upside is presented in multiple dimensions, as I was talking about, the property, the location, and the operations, then we go after that deal. We are personally invested in almost all of our deals. And in almost all of our deals, we are actually personal guarantors on these loans. So we take a large amount of risk and put our money behind all of these deals to make sure they are successful. So we do have a track record. I think we have probably summarized that well enough, but you can even talk to some of the people in our circles and ask about us. So we are an open book and we would actually encourage that, ask around, get feedback about us. We're more than open to that. So yeah, I think that's what I would like to say here. Anything else, Andy, that you would like to add on this slide?
No, I think maybe one last thing for investors to take away before we hit questions and answers is, what the seller lacks and the reason the seller has failed, at converting Batavia Meadows is what we bring to the table. So we're that missing puzzle piece. And that's why this is an opportunity for us. As Jay said, this is our first rodeo. We've done full redevelopments, fully vacant properties before. So, not to say this is a walk in the park, but it's definitely not on our higher risk radar of deals that we've done in the past. So I'm excited about it. I think this is a great opportunity for those investors that are new, those that are experienced, to get on a property with operators that are fully integrated. And before we get to questions, I just wanted to let you know, since I'm managing a lot of the capital raise for this, we are about 65% subscribed on this opportunity. So those that are interested, we urge you to reach out to us. You can set up a meeting with me directly or Jay, and we can talk through any additional questions maybe we won't get to tonight. But we are encouraging investors to fill out a soft commitment form via DocuSign just to get in line. And there is a pretty high potential that maybe some won't make it into this deal with a lot of the interest that we've been getting. So not to worry, we'll have more deals coming down the pipeline. But let's get to the Q&A, Jay, just to be respectful of everybody's time, unless anybody else has anything to add.
Yeah, we have a few questions in the Q&A box, and I'm also going to let people unmute if anyone wants to chime in and ask a question. So
why don't we hit the Q&A box first, get those out of the way.
all right, so the first question we have, Andy, is how much money are the sponsors putting in? Do you want me to start, or you want to go ahead and I can add on?
Go right ahead. I would just say that it's subjective to every deal that we do. As Jay mentioned, we actually taken a lot of risk signing on the debt. It's personal guarantee, which we will on this deal. And Jay, if you want to add anything to that?
Yeah, I just want to give a very honest answer to this question. It is an important question, I think. Basically the question is, do you guys have skin in the game, right? And if I was a passive investor, I would be asking the same question. So I get it. Also, although you have to see it from our point of view, that as lead sponsors, we have to maintain liquidity for a few reasons. If there is something that is unexpected on this deal, we always need to maintain some liquidity to basically save the deal or put in that money or emergency fund for that deal. And we have done it a couple of times before when unexpected things happened in the deal, and we have put in temporary capital injection, right? So we need, as sponsors, some liquidity to do that. Additionally, as sponsors, we need liquidity to run our operations, our marketing, the communication that goes out to all of you, right? So there are a lot of the things behind the scenes in terms of operations that we have to pay for which we need the capital. Now, traditionally, we have put our money in every deal that we have done, but we just internally discussed very recently that we just can't sustainably continue to do that, because then we will be out of liquidity ourselves. And what happens when next deal comes to the table? We won't even have the money to put down the EMD for that deal. So for this deal, it's technically TBD. If that is one of the things that is extremely important to you all, maybe we will put in about 50K in our own capital, but we are signing personally on a recourse loan. So if anything happens, they can actually come after our cars and our houses. So this is not a non-recourse debt. So we are taking a pretty large risk by all three of us signing on this debt. So I think hopefully that is enough skin in the game. So we are definitely making sure that our interests are aligned. We are signing on the debt, and we can also consider putting in some money in the deal. We just cannot put too much money in the deal because we always, like I said, need liquidity to run our businesses. So Andy, anything else you'd like to add?
Oh, very well said. We already have money in the deal for EMD now, and what additional is TBD, as Jay mentioned. But I think the biggest takeaway from a question like that, it's a great question, is what's in it for the sponsors, and what's in it for us, and what do we have at risk is personally guaranteeing the debt. So that's a pretty big risk, in my opinion. Let's move on to question 2.
We have, why are sponsors owning 30% equity and also keeping 30% profits, and then 40% after waterfall hurdle is met? New to this model, would appreciate some explaining. Okay, maybe Andy, if you want to start with that, I'll also pull up the slide with that.
Yeah, well, it goes back to why are we owning 30% of the equity? Well, we're executing the business plan. So it's a significant amount of work for an asset manager to take on implementing the renovations of 54 units, managing the property through prosperous communities. So that 30%, 30-70 splits is pretty common. It's pretty typical in the syndication. It's actually fairly generous as well, I'll say. There are those that are 60-40, 50-50 that we even see. So for those that aren't as familiar with the syndication model, 70-30 is a pretty generous equity split between, limited partners and partners. Jay, you want to talk about why we're keeping some of the profits and then the waterfall?
Yeah, so essentially, I think one of the questions was, why are sponsors owning 30% equity, but also keeping 30% of profits? So it's essentially, we're not keeping an additional 30% of profits. The 30% of equity, whatever that amounts to, is what we are keeping. And one thing to note, again, the point I made was preferred return. So the 70-30 split in cash flow distributions only happen after the first 5% is paid out to investors. So it's actually, if you look at it, it's actually going to be less than 30% that we keep, because the first 5% directly goes to investors as a preferred return. And so for example, if the property cash flows 7% in a certain year, the 5% goes to you, the balance 2% gets split 70-30. So that's the definition of preferred return. Now in syndication model, why do we do preferred return? To prioritize investors. In joint ventures, usually it's a straight split. But then on the tail end, if we are giving you preferred return, which means in first year, we don't have a cash flow. Second year, we have about 3.9%, I believe it was, which means all of it goes to investors. We keep nothing. Year 3, we are again on low cash flow situation. So most of it goes to investors. So why do we do this waterfall model? That way we get incentivized only if the property overperforms. So after 17 IRR, if we have over-delivered, then we keep a slightly larger chunk of the profit, which is the 60-40 split. And if you're not familiar with the syndication model, why is that a good thing? Because if sponsors are, it's almost like giving someone a performance bonus. So if you're giving your employees a performance bonus for better performance, they'll probably be even more motivated to perform well. It's the same philosophy. So if the property over delivers, and if the sponsors are motivated and incentivized to make sure that the business plan, we actually far exceed the business plan projections, that's when we take a 60-40 split. So it's a very common model in syndication. So if you're not familiar with this, I've even seen hurdles where people do 70-30 in reverse after a certain hurdle is met, meaning 70% to sponsors and 30% to investors. So just dropping it down by 10% is, again, and you can talk to other people who have invested in syndications, is not, it's not, crazy. We're not being greedy in that sense. So it's a pretty standard model. If you need to get some more information about this model and how these deals are typically structured, we're more than happy to do a one-on-one call with you as well. Tax benefits, depreciation question. So will we get depreciation through K1? Andy, do you want to take that one?
Go ahead. The answer is, Jay?
Yes.
That's one of the best benefits of investing in commercial real estate. Those tax benefits. So tell them a little bit more about it.
Yeah, absolutely. So we will be doing something called as the cost segregation study. At a very high level, what that means is someone who is very familiar with accounting side of things and construction, there are companies that do that. They take a look at what the property is worth, how much money we are putting in, and on what schedule those items can be depreciated. As an example, roofs can be depreciated, I believe, over 15-year timeline. The building itself, 27.5 years. Land itself can never be depreciated. So we look at all of these different line items and then depreciate them on different schedules, which is called accelerated depreciation. So we will be doing a cost seg study. the bonus depreciation, also 100% bonus depreciation might come back. We are waiting for the final outcome on that. So that depreciation will reflect on all of your K1s. So that's definitely one of the biggest benefits. So if you have any other passive income, or if real estate is your active income, you can actually offset that income using the passive losses that you will get on your K1 forms.
Yeah, one thing to add too, your benefit through this, the tax benefit is parallel to your capital contribution, right? So it's gonna ride right along there. It's 100,000, you're gonna get a parallel capital, right? The K1 that is equivalent, obviously, to that capital contribution, your equity share. Same with those that are investing 250,000, 300,000, 400,000. So it's not stagnant.
Mhm.
Let's go to the next one. It said, what do you see as the key risks in this deal? Jay?
So if we think about the key risks, I mean, when we try to underwrite the deal, we think about all of these aspects, right? So one risk is we don't get the rents that we are projecting, which is why we are projecting lower, bottom of the barrel rents as compared to the competition. One unique aspect about this deal is also CMHA tenants, right? But the property is not required to be under Section 8. So all the requirements are already gone. So we can convert this to market rent tenants, which is how it's currently underwritten, right? But let's say we are not able to get all the people out, right? Actually, on the flip side, the other scenario is even better, where we keep the Section 8 people, because after our unit walkthroughs, we realized that most of them are actually keeping the units very clean. They're very quiet people. A lot of them are seniors. So we just do the exterior improvements and just increase what the government pays us. That way, it's a win-win for everyone. The tenants don't have to pay more. We are getting a bigger check from the government. The tenants are happy because they get a much nicer property to live in. So that's actually another scenario of this. If we are not able to convert this from an 80% Section 8 to maybe, let's say, 20% Section 8 or all market rent, right? So that's another possible outcome. The other risk I think I can think about, it's a 1980s asset. So it's not really old, but it's not brand new either. So it could happen that when we start working on the asset, we might come across something, we might discover something, which is why we have reserves. And given that we have a pretty hefty interior and exterior CapEx plan, it's highly unlikely that we will uncover something because almost everything is being redone. So I think that's just another aspect. I don't know if I can think about a risk that we have not discussed, Andy. I don't know if everybody leaves Batavia. I mean, that's a risk, but how likely, what's the likelihood of that happening? So,
Yeah, I think you hit on the two main ones, which is just, rent projections and, you know, in any real estate deal where you're renovating, you never know what the previous owner did, right? You never know what's behind walls sometimes. You never know if there's bad plumbing. But I gotta say, in a property of this vintage, I mean, we've done renovations on the 60s built, right? And you're getting the cast iron and potentially block foundation. So to me, I think we're mitigating a lot of risks by it being an 80s vintage property. But with any investment, there's risk, right? I think there's a lot more controlled risk than an investment like this, in my opinion.
yeah,
So,
agreed.
let's move on, just for sake of time. What are some of the risks you've identified? We already did that one. Are there any circumstances better than expected rent growth that will result in you deciding to hold the property longer, or an offer you cannot refuse that will result in you deciding to hold the property short? I think I can comment a little bit on this. I don't know if somebody offers, $10 million in year 5. I don't know that any of us would want to turn that down. Your equity share would have, corresponding value. So I think if our job as asset managers, sponsors, is to implement this business plan and to do one thing, which is to grow your equity share. If we can do that faster, to me, that's a win for everybody. So I don't know that better than expected rent would allow us to hold it longer. I don't know if our goal is to hold it past the 7 years because, people have to repurpose and cycle money. There is a time velocity value to money, which is the internal rate of return. But I would say that in the event in any market, and the market cycle that's happened back in 2021, 2022, you saw a lot of people that were 5-year holds that were selling in 24 months, 18 months, 36 months. So I don't think it's out of question, but I think that is really going to be driven by the interest rate environment that we're in, parallel to how we're implementing our business plan and how successful it is. Jay, would you like to add anything?
No, I think that was spot on. I mean, we could sell sooner if we are able to exceed our projections, because our responsibility is to you all as investors. So if we have met and exceeded the returns that we are projecting here in 3 years, we can sell it sooner. And one thing we all know is we can never time the market. So if the market is significantly better and our business plan is executed, we get good value for the property in 3 years, we'll sell sooner. Similarly, at the end of year 7, may not be the best time to sell. It all depends on how the market looks like in 7 years. And in that case, we might end up holding longer until it's the right time to sell and we can actually get our projected returns. So, yep, absolutely.
Next question. Do you have any experience managing subsidized housing, specifically Clermont Metropolitan Housing Authority? I don't think CMHA is unique, right? If it's subsidized housing, it's subsidized housing. And the answer is yes, we do have experience. We transitioned our Milford property over from tenants that were Section 8 to a full market rent, full market rate tenants. And CMHA is really no different for us, and I don't foresee any issues whatsoever. Back to what Jay said, subsidized housing gets bad, but one thing I'll say, having some subsidized housing in my own personal portfolio, is 8 out of 10 times, those residents don't want to lose that subsidized housing. So they're a lot more willing to keep their property clean, as we've experienced with this property, walking it, and as well not cause trouble, because the last thing they want to do is lose that subsidy, right? Because it's really important to them. So Jay, thank you, Dan.
No, you covered it. I think just one thing I would like to say is subsidized housing is also different. Not all subsidized housing is created equal. So in the US, some of the subsidized housing was created in rural areas. And a lot of the subsidized housing also is in the areas where there is low affordability and higher crime rates, right? Because there's a need there as well. In this situation, it's actually the former, right? Batavia used to be a rural area, which is why there was this subsidized housing. It's not because this is a low income, high crime neighborhood. So the type of tenant base, although on subsidy, that we see here is very much different than what you would see in some of the other parts of town where the crime rates are a little bit high, right? So which is why we think that even if we have to retain some of the CMHA tenant base, it's not a bad thing. Do we have experience? Yes, we have experience managing CMHA tenants. We have experience converting a CMHA property to a market rent property. It's going to be just a little bit more of an administrative overhead and annual inspections that CMHA does. But besides that, it's not so much different from any other rental property. So I think hopefully that answers the question. I think we can move on to the next one. Have you done sensitivity analysis of getting mortgage at higher interest rate than 6% you have currently? Yes, and I think we do have that sensitivity analysis slide as well that we will be sharing. So we have an even more conservative estimate. So we can also throw in those numbers. So when we share the slide deck, you will get that sensitivity analysis slide. We have it in this presentation. But if you want to connect with us one-on-one, we are more than happy to walk you through it as well. So that's for I think the refinance 6% rate. Okay. I hope that answers your question. I think just to save some time here. I think we'll keep moving. Why
Sure.
not double down on CMHA and save on renovation costs?
I can answer that. Just CMHA is always going to have a cap, right? I think they're a great tenant base to have, cash flowing day one as we take this project on, but they'll never meet market rate, right? We'll always be able to exceed rent with market rate tenants. I think that's the straightest answer I probably could give you. So maybe a blend of both, right? I don't know. That's the business plan here. Jay, what do you have to say?
Yeah, I think we have discussed this internally as well. And besides a handful of people who are not really keeping their units clean, there is really no reason for us to ask these people to move out. So our first attempt is going to be keep the CMHA people in place, start improving the property. That way, everybody sees the improvements we are making to the property, ask for higher rents from the government. So now we get our rent increase. And hey, if we don't, instead of 54 units, if we have to renovate 10, 15, 20 units, that's icing on the cake. It's just that we cannot assume that. Our assumptions have to be more conservative. If we are able to actually execute on that business plan where we only renovate a handful but still get the same pro forma rents, I mean that's a bonus. That would be great news. Floating interest rate for 3 years as a risk. So I would just clarify that it's not floating interest rate. If it was, we wouldn't have taken this debt. We never do any deals on floating interest rate, especially in the volatility that we have seen in the interest rate environment these years. It is fixed rate of interest for 3 years. So it's basically a 3-year ARM type of a product. So for 3 years, it's fixed rate of interest. The term of the loan is 300 months, which is 25 years. So after that, it's not like a balloon payment is due. It will still continue, but the rate would adjust. So I think 3 years gives us enough time to stabilize the property. Our runway for stabilization is really more like 18 months, 2 years to be conservative. So 3 years actually gives us enough time. By that time, we would be refinancing the property. So there is no floating interest rate on this one. So it's fixed interest rate at 7.5.
Last question I think we see here from Russ. When will the investment funding be due? We really like to try to get wires start to come in here as we get into the last week of March, if not sooner. We're going to have wiring details as we get a little further on through this month when the appraisals are finished. Anything else to add, Jay?
No, I don't think so, Andy. I mean, as you alluded to before, we are 65% funded. So I think we have enough cash to close. Again, not trying to push anyone, but if you are truly interested in this offering, we would suggest that at least put in a soft commit sooner than later. And I think we were targeting a close of early April, end of March. So I think by third week of March, if we are able to get the wires, that will be great. That way we know that we have all the capital needed to go ahead and close the deal.
Yeah, and I'll just mention that typically we've historically approached, wires in is, obviously guaranteed equity spot. So soft commits without wires, unfortunately, if somebody puts the wire in first, we'll have to obviously take that as precedent. So those that are interested, we'd love to have you in this project. Very excited about it. I think it's a good win for us, and I think this is a market we know. So those that haven't invested with us before, just know that this isn't our first time doing something like this, and we're excited to have you. So any other questions? Jay, anything else? DJ, any closing remarks?
There's one question that has popped up. Is 1031 exchange a possibility? So I'm not sure if the question is about 1031ing into this deal or out of this deal at the exit. So into the deal, I would say, Andy,
No, unfortunately.
it's tough unless it's a bigger check. In that case, we can internally discuss because it is a lot more complex. It has to be done as a tenant in common, it has to be set up as a TIC. The legal work takes some time. So if
Typically for a TIC, it's got to be a minimum of
Yeah.
half, if not more. There's a significant administrative cost that is associated with that.
exactly.
Any
Great.
other questions before we break? Appreciate your guys' patience. I think we got most of all of you. It's almost 10 o'clock, so good group here. DJ, would you like to address the crowd before we take off, or anybody got anything else? No? Okay, great.
Awesome.
Well, everybody, thank you for joining us for the webinar. As Jay mentioned, we will have this recorded to send out to you. You've got our contact information for additional info or questions related to the offering memorandum. And we look forward to the partnership. Thank you so much for your time.
Absolutely. Thank you all so much. And our contact details are on here. Please don't hesitate to reach out to us, especially if you're starting out and you have never invested in a syndication deal and you have any questions about, what does that number mean? What does that metric mean? We are more than happy to answer those questions. So you can either use our Calendly links to set up a time with us or reach out to us directly via email, and we'll be more than happy to do a one-on-one with you. So again, thank you all so much. Really appreciate you hopping on this call today.
Thank you all. Take care, everyone.